For this week's Smith Business Close-Up, we're on location at the University of Maryland, and joining us is Professor David Kass of the Smith School of Business, a clinical professor of finance. Thank you for being with us.
Well, thanks for having me.
You have been an investor, an individual investor, for over 50 years. Most Americans have some money in stocks, either directly or through retirement plans. When things get volatile, what do you do?
Well, I try to control my emotions. I set long-term goals for myself, and I'm looking out 5, 10 years or longer, and try not to be influenced by the crowd or herd instinct. When everyone else is selling, I try not to. But occasionally at market extremes, such as during the financial crisis of 2007 through 2009, when the Dow Jones average dropped by 55%, it was pretty hard to hold on to everything, knowing or feeling that whatever I own today is going to be worth less tomorrow and worth that much less the following week or month. So at those times, I did do a little selling, but basically holding on to, in my case, maybe 90% of what I had invested in the market. So my advice in general is try not to be influenced by short-term movements in the stock market. And I define short-term, it could be over weeks or months, and not necessarily just a day or two, but try to be focused long-term. And it is really a function of the individual as to what percentage of his or her assets that they choose to allocate or invest in the stock market that they're comfortable doing. For some people who are very risk averse, the right answer may be 0% and be very conservative, invest in treasury securities and sleep well at night. For others, maybe 50% of their portfolio in the stock market they may feel comfortable with, and others even a larger percentage than that. The expected returns over time are higher for stocks than, say, fixed income securities such as treasuries, but with the higher expected return comes higher risk over the short term.
It's really a fascinating little confession that you, as a PhD, professor of finance, experienced investor, still sold a little bit, it sounds like, at the bottom or close to it.
Yes, and what happened there, going through my mind, even whether as a professor or just an investor, are probabilities. I know what has happened historically, the last 100 years, 200 years. I know what's likely to happen in the near future, but there's no certainty. And during the financial crisis, we had excellent leadership at the Treasury, both in the Bush administration at the end and certainly in the Obama administration. Paulson at Treasury and Tim Geithner, Hank Paulson and Tim Geithner, and Ben Bernanke at the Federal Reserve making the right decisions and doing the right thing, but there was always the risk of a bad decision being made.
But it was interesting that you said you didn't sell everything. You sold a little bit.
Right.
And does that maybe take the pressure off if people do feel a need in an extreme market situation to do something? Are you saying it's okay to do something?
Well, again, each individual is different. We each have our own, degree of risk aversion or tolerance for risk. In my case, I just felt the need to do something, even though I'm trying to be well disciplined and essentially do nothing. But I felt the need and the desirability that there was some non-zero probability, maybe very low, of a worse outcome for the economy than I was anticipating. And this was sort of my way of protecting myself a little bit. And I could see applying this to other individuals. I think it is human nature when one sees the market plunging and maybe your friends, colleagues, advisors, stockbrokers, whoever, are advising, doing some selling, there is this tendency to do some.
So how do we fight human nature?
I guess it's very difficult. I would say certainly plan in advance. really set your goals, be really firm. I have these, let's say, 10-year time horizon, for example. I'm planning for my retirement. I'm investing for my child's education. The funds that I'm investing, largely I won't need for the next 10 years. Hopefully I've set aside in more liquid assets the funds that I anticipate needing in the short run, and just try not to let day-to-day fluctuations bother me. And that's what my advice would be to the average investor.
Very good. David Kass, Clinical Professor of Finance here at the Robert H. Smith School of Business. Thank you for being with us.
Thanks again for having me.